Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Well, welcome everyone. Thanks for tuning in. We've got a great audience that has joined us from all over the country and all over the industry, and I'm very excited about today's event. A quick introduction, I'm Brian Love, your moderator for today and head of banking and fintech at Travillian, which is a boutique executive recruitment firm serving the financial services space since 1998. My division specifically covers community banks around the country, assisting with executive search and succession planning for boards, executives, and senior leadership teams. My team and I are extremely passionate in finding the right game-changing talent to help our clients execute their strategies. Please check out TravillianGroup.com for more information about our practice, as well as TravillianNext.com for more great content like today's event. So now to get started, we titled today's webinar, It's Time for the Tough to Get Going, Banking in 2023, an Investment, M&A, and Regulatory Perspective. And this is because it's been an extremely challenging year for the banking sector for reasons that have been very well documented. 4 notable banks have failed and a panic ensued, which for a time seemed to threaten the broader sector. While the panic seems to have subsided at this point, bank sector fundamentals remain challenged. Stock prices are down and capital markets activity is very muted. Rarely has there been a time in which the outlook for the sector has been more uncertain. Here today to talk through these issues and provide some insights are 3 guests that I'd like to introduce to you. Bob Toma is Managing Director in the Financial Services Investment Banking Group at Raymond James, which he joined in 2015. Bob has almost 25 years of experience advising depository institutions on M&A, capital raising, and strategic planning as one of the sector's leading investment bankers with a primary focus on the Midwest region. Bob, thank you so much for being with us today.
Thanks, Brian.
John Reichert is a shareholder and member of Reinhart's banking and finance practice. John serves as general counsel for community banks, bank holding companies, and other businesses in the financial services industry. His work involves corporate governance, capital formation, M&A, asset divestitures and purchases, regulatory and compliance matters, commercial lending transactions, and general securities matters. John, appreciate you taking the time to join us today.
Thanks, Brian.
And lastly, Joe Fenech, my co-moderator on many of our prior webinars, is moving to the other side of the table today as a panelist, offering insight from his perspective as Chief Investment Officer of GenOpp Capital Management, an investment firm he founded 3 years ago. Joe has been a close follower of regional community banks for nearly 25 years. Joe, good to see you.
Good to see you, Brian. Thanks.
So as I mentioned earlier, the purpose of the discussion today is less so about recapping what's happened to date, because that's been covered very extensively, and more so about where we go from here. With that in mind, we're going to cover a wide range of topics, including the outlook for bank sector fundamentals, the current and future state of M&A, the regulatory environment and how any changes there might impact the sector outlooks on stocks, technology, and then how all of these developments might impact banks' talent needs, which is our bailiwick here at Travillian. So without any further ado, let's get into it. Bob, I'm going to lead off with a question to you. As an investment banker, you're privy to a lot of behind-the-scenes conversations. What are bank management teams and boards talking about right now? I'm especially curious about whether in those behind-the-scenes conversations, management teams believe the fears about the sector are overblown, or whether there's real concern about where things may be headed.
Thanks, Brian. I think it's a blend of both. I mean, there's real concern and there's areas of disconnect, I think, between where stocks are trading and investors' viewpoint on the future and where we're discussing with management and boards. Certainly post SVB and the bank failures in March, we were spending a lot of time on clients, kind of evaluating the current situation. And we've kind of articulated in kind of a three-phase, I don't know if you want to call it a crisis, but situation we're in. First and foremost is liquidity. Most of the community banks that we cover, traditional commercial retail client bases, they don't have the concentrated deposits or liquidity issues that SVB and the others had that led to failure. And that was pretty evident that that wasn't spreading pretty quickly in the weeks or days after SVB in March. Folks were not seeing, I don't think I had one client that saw material outflows in their deposits in those weeks or months ahead. But shifting to the second phase, structural profitability, and eventually the third phase, credit, these are where we're spending a lot of time with management teams, particularly on the structural profitability. So even though the panic of the failures didn't really lead to widespread deposit withdrawals at traditional banks, it has led, there's a big advertising saying your bank's paying you too low on your current deposit rate. And we've seen rates rise rapidly. We've seen non-interest bearing deposits deteriorate. We expect those to continue to go down, certainly to the levels that they were pre-pandemic, but even levels that they were at in the last, heightened interest rate, which is pre-financial crisis. So most of the time we've been spending with boards and management is really looking at effectively pricing loans. There's quite a bit of underwater assets if you look at their current marginal cost of funding. So reevaluating how you're pricing credit, making sure you're pricing over a spread of your current cost of funds, putting in floors, and really carefully evaluating your clients, requiring more deposits, and pushing out non-relationship customers to really be judicious on how you're managing that balance sheet. And most of the stocks, most of the clients that have their public have kind of all been thrown out with the bathwater, and certain ones will manage this better than others. And we think, looking forward to the back half of the year, those that can really effectively manage their margin and even sacrifice growth, but preserve, a margin where they can make a competitive ROA and ROE, we'll see their recoveries happen first, and likely be in a position to capitalize on those that continue to see margin deterioration because of large fixed asset positions on the balance sheet that are now being funded at multiples of where the deposits are rolling off at. And then the third phase is credit, and this is probably the biggest differential we see between investor expectations, what's kind of implied in current valuations, and when boards and management teams are seeing in their actual portfolios. No real pending signs of credit deterioration, either in the March quarter or what we can tell coming out in this in the second quarter here, which we'll know in another few weeks. But certainly a rise in expectation that it's coming. If rates stay higher for longer and these rates reset at current values, there's certainly an expectation that credit costs will elevate, and they're really spending a lot of time being proactive in managing the vulnerable sectors. Providing more disclosure on these asset classes to investor, I think, helps. Clearly, office real estate is going to have some pain, particularly in the metro areas. Most of the clients that I cover in the Midwest don't have a lot of exposure to begin with, and very little in downtown metro office. So really kind of parsing that, disclosing their exposure, their loan to values to investors, and being proactive in managing those relationships, both from rate and credit, is where we're spending most of our time.
Yeah, sensing a little bit of optimism there, which is good. Joe, similar question to you, but from the outside looking in as an investor in the space, from your channel checks, what are you hearing, and what do you think it means as we move forward?
Yeah, Brian, I'm going to mostly agree with Bob here. So I think it's important to distinguish between this sense of panic around what's happened from maybe the more general concern about what the business models of these banks, what Bob was saying about structural profitability, what the business models of these banks are going to look like as a result of what's happened, right? So in my view, the panic's over. There may be a few small bank outliers that have serious problems, but for the most part, the fear that we'd see contagion after the events in March and then early May, that subsided. And that's a big deal, I think, relative to where we sat just 60 days or so ago when First Republic failed. And I don't think that's an out of consensus view. You asked about channel checks. I don't get the sense in talking to some of the banks that could be potential acquirers of failed banks. I don't get the sense that those acquirers are gearing up for the next potential failure. And it doesn't seem to me that the regulators are suggesting to those banks that they should be prepping for that. Having said that, I think, like Bob said, the next few quarters are going to be challenging for bank fundamentals. I don't think there's any doubt about that. Second quarter results will come out here in a few weeks, and that'll reflect, really the first full quarter impact of the actions that banks took in March to shore up their funding and liquidity. Remember, that happened right at the end of the quarter, so we haven't gotten the full quarter glimpse of that yet. I also think we're going to see higher provisioning for potential credit issues. So more broadly, I think it becomes a question of, to what extent are earnings expectations still too high? But that's a much different conversation, with much less serious implications than the conversations we were having just 2 months ago, which centered around the question of, which bank is next if this panic spreads.
Thanks, Joe. I want to get John's perspective, obviously a different perspective, the legal perspective. Anything to add to Bob and Joe's comments? And then kind of a specific question for you. Are the conversations and considerations in navigating this cycle different depending on the profile of the bank, meaning private banks, credit unions, are those considerations and conversations different?
Yeah, I don't think I have anything to add to what Bob and Joe had said, but I think the conversations are absolutely different, Brian. We had talked about this offline. There's 1,000 banks chartered in the upper Midwest, and they cover the whole spectrum, right? So I view them in a couple different buckets, right? We've got banks loosely under $1 billion, and then $1 billion to 10 and 10 and above, and that's just, again, loose parameters. And then within that, are you public, are you private, or are you family held or closely held? And I think once you figure out where you are in those categories, they approach this differently, right? What resources do you have? What expectations do you have, right? Are the markets and people like Joe and Bob expecting certain things, or can you approach this from a generational planning standpoint? How many tools do you have in your toolbox? So I do think when people say, they lump all the banks together and say, what's happening to banks? How are banks reacting? How are they being affected? That's a little overly simplistic. And you had mentioned credit unions. That's a whole different category as well. But even within the clients we work with, we always have to stop and calibrate to, which bank are we at, and what's their view of the world? What lens are they going through the cycle through?
Yeah, it's a good response. Same on talent. There's some macro things that are the same, but every story is a little bit different as you dig in. Well, let me move on to another subject. Joe, I wanted to delve a little deeper into the fundamentals of the banking sector. And you mentioned that you said the panic is over, which is great to hear, but that the fundamental picture is becoming more challenged. And then similar to the question I had for John on the conversations that banks are having, from your vantage point, is the fundamental picture and the outlook different depending on the size of the bank, the geography of the bank, or the business model they operate? Or is everyone basically in the same boat at this point?
Yeah, Brian, I think to some extent, everyone's in the same boat in that no bank's going to be immune from some degree of fundamental pressure, right? Whether it be funding costs or reserve build or what have you. But the magnitude of the challenge is, I think, going to be very different based on the size of the bank and even the geography to some extent. I'm least concerned about the very largest banks. The funding pressures, are just less acute there. And I feel like we've got better clarity on the earnings profile and the business model and what those are going to look like on the other side of the cycle. If you think back to the pre-08 operating environment for banks, the big banks always had a very discernible funding advantage over the little banks. And that's why the big banks pre-08 tended to trade at a premium to the small banks. Back then, and Bob and John probably back me up on this, I don't think it's an exaggeration to say that maybe only 2 or 3 of every 10 small banks truly had a good core funding base, right? And then 2008 rolls around, the big banks suffered huge reputational damage, and rightfully so. At the same time, interest rates go to zero and stay there. And so for the next 15 years, all banks are basically on a level playing field from the standpoint of their core funding base. So, if customers aren't expecting a return on their deposit, what difference does it make where you keep your money, right? So we saw small banks with 25 to 30% non-interest bearing deposits over these last 15 years, whereas it was closer to 10 to 15% when interest rates were last at these levels pre-08. So the question in my mind is, in a more normal interest rate environment, will the funding composition of the smaller companies revert back to that pre-08 environment? We don't have the answer to that question yet. And so that's a big reason why I just think there's still a lot less clarity on the business model and the earnings profile of the smaller companies as compared to the larger banks, at least at this point.
Yeah, just really quick to echo one of Joe's points. I mean, probably the biggest topic of conversation we had at the strategic level in 2006, 2005, 2006, before the financial crisis and low rate environment was disintermediation and moving bank deposits into money market funds, online broker dealers, online banks paying high rates. That began to happen. We've obviously had a big ramp up in technological ability and competition, but only in a low rate environment where it really didn't matter. And now it matters again. And it's an old problem that's going to rear its head. And I know it's really difficult for our management teams to have a lot of confidence in where their non-interest bearing deposits are going to end the year, or even in future years, depending on what the Fed does.
John, did you want to chime in on that?
No, I don't have anything to add on that particular issue, Brian.
Okay, it sounds like, you know, the funding piece is the big focus. I hear that at every conference I go to. It's a large part of what we're talking about. Well, John, let me get you involved here in a part of the conversation that I'm sure you're well equipped to talk about, regulation. And we'll get to M&A too, which is, you know, the meat of the sandwich of this webinar. It seems clear at this point that the vast majority of any new rules we're likely to see are going to focus more intently on larger banks. And that said, new regulation over time tends to filter down to the smaller banks, either explicitly or just in terms of what the regulators choose to focus on any given exam cycle. What are your thoughts on what we're likely to see in terms of any additional regulatory burden, specifically on smaller companies? What are the implications of that? And then what are you advising banks today in anticipation of this?
So I'm going to answer your question without answering your question, Ryan, right? Your point about starting at the big banks and filtering down, I think is relevant in what we see in the banks that we work with. So undoubtedly something's going to come. There will be changes. Much like, you know, Bob talked about 05, 06, 07. Even back then, people knew things were going to change. They didn't know how. And then as it starts to roll out, you digest it, you try to work with your trade groups and influence it to the extent you can, and then you adapt. So I think that's what will happen here. I think what people are seeing, and I know we'll talk about this more later, especially for some of the mid-size and smaller banks, they have so much on their plate right now that they do know that they're wrestling with. You know, for example, technology, fraud, succession planning, liquidity. And when I used to say liquidity, it was shareholder liquidity for our banks. Now it's both shareholder liquidity and balance sheet liquidity. You know, against talent acquisition, retention, succession, scale. And those are off the top of my head. So I think, you know, you add the regulatory burden as it exists today and what it might look like in a few years. They're aware of it, but few of my clients have any time to actually sit back and reflect and try to handicap what the regulators are going to do.
And I'm just kind of curious, like, is there any trend in exams that you're seeing this year of any sort?
Not that we have heard thus far. I think that's another area where people are anticipating some change. One of the things that started before the most recent cycle was whether or not that certain deposits are considered to be brokered. So that isn't, you know, that's evolving. There was some guidance that came out a year or two ago where the FDIC tried to clarify, you know, what's core deposits, what's brokered. And so that has led to a lot of discussions, both, you know, in exams and outside of exams as to, you know, is this brokered money or not? There's a lot of swap programs, sweep programs, all these different things. So we spent a fair amount of time there, not just trying to find deposits, as Bob and Joe talked about, but then to figure out what are they.
Well, let me get Bob involved here in his bailiwick, M&A, and then we'll tie that back to the question on regulation that I asked John. So Bob, given everything that's happened so far to date, it's probably not surprising to anyone that M&A activity has been muted, as I said earlier. So I think we can agree that the panic has subsided, but the fundamentals are still challenged. Though in the past, once we move past the panic phase, M&A tends to pick up pretty quickly. Do you see that happening again in this cycle? And what are the circumstances that make this cycle unique relative to prior M&A cycles?
Yeah, I mean, I think, you know, the fundamental driver of particularly community bank M&A has just been this fundamental pressure on margin, which if you were to chart net interest margins for banks under 10 billion back to 1990, it's a 45-degree angle down. Of course, there's spikes along the way. But anything that's accelerating that trend or continuing that trend is going to lead to further consolidation. Most of the banks are spread-based lenders. In order to grow EPS, they need to get bigger, whether that's organic growth in M&A And obviously, depending on the markets you're in, organic growth, can be limited by the opportunities in your market. So we expect, I don't know if it's quickly because of the timing of this period, I think is the big uncertainty. But certainly we expect M&A to pick up in a big way. What I think is different here than prior cycles is if rates stay higher or elevated now, this will be the first time we're really running meaningful interest rate marks since purchase accounting was implemented. The current purchase accounting rules really came in a zero interest rate environment, and the interest rate marks on these deals were sort of afterthoughts. We didn't even model them initially, and we'd get a report, closer to signing or to close. Now they're significant. In fact, they're so significant that a lot of times they're eating up the entire capital base of the target. So buyers need a lot more capital to absorb these. We think those that can really get quite a bit of tailwind because all that interest mark comes back over time as the assets mature. So there's big earnings tailwinds that help you through this type of environment on your own. And you're picking up a chunk of the pro forma company at fully mark to market value. So you have a lot more liquidity. You're actually able to sell those loans and securities without implementing losses, unlike the legacy book. So that's coming. But, as it stands today, a lot of the larger deals would require additional capital to get done, even on an all stock basis. And with valuations where they're at, I think we need to see an improvement before buyers really find that significantly attractive. Of course, the big wild card's credit. If credit has not reared its head, but if it does rear its head, that's kryptonite for M&A. M&A will go on pause until credit confidence returns and folks shore up their own balance sheets before they're willing to take risk for others.
Well, Bob, I'll stick with you on that point. When M&A inevitably does pick up, let's hope that's the case, and the credit stays stays where it is. Do you think it'll take the same form it has in prior cycles, in that we see typical straight up acquisitions where the buyer acquires the seller at typical market premiums, or do you think deal structures maybe take a bit of a different form? And then John, you can jump in on this after Bob.
Yeah, I think, in addition to the rate mark impact makes it difficult to do larger, strategic MOEs, which we saw a lot of, coming out of COVID. And I think we'll continue to see those, but they just need to be supplemented by capital. But, as the number of banks dwindle, and coming out of this, we expect the number of buyers to dwindle. I think regulators that have banks that had unanswered MRAs, are going to hammer management and perhaps restrict their ability to do mergers of equals or become buyers. And those that are going to be in a real position of strength, it's not going to be everybody that it once was, just 2 years ago. So I think if we see a big supply of sellers, come onto the market here as the environment improves, I think they need to be very careful on examining who their logical buyers are and putting a compelling thesis in front of them really up front, because the strong buyers are going to have a lot of choices, coming out of this, and really getting their attention and their best foot forward is imperative, because over time, if you're eventually looking to sell your bank, most likely the number of buyers is declining, not rising. And of course, that'll change. Some of your buyers will sell and go off, and some of your competitors will grow and become new potential buyers. But over time, that universe is declining. And so more sellers, I think, have to be thoughtful in how they approach that to maximize the buyer engagement with the strongest buyers that are in their market.
I agree completely with what Bob just said. I think there's a lot of sellers. I think one thing we're seeing, and I don't know if it'll continue, is that when we had the last, what I'll call the cycle in 07, 08, it took a long time for sellers to recalibrate their expectations, right? They thought, we're still going to get 2 times book or multiples of what have you. Took years, at least in our space, for that to kind of recalibrate and for deals to get traction. This time it's happening much more quickly, I think. People are saying, gosh, I wish I'd sold a year or 2 ago, and then they look at all those headwinds I mentioned earlier, and the people who were going to sell in the next 3 to 5 years anyway are starting to adjust to the reality that we may not get back there quickly. So to Bob's point, I think, there's a pause, but already we're starting to see the sellers line back up and say, okay, I may not get what I thought I'd get, but what are my options and how do we move forward? The other thing we're seeing is, and it goes again to Bob's point about buyers, the traditional buyers are dwindling in number. They're still out there for sure, but they're going to be seeing and getting looks at a lot of opportunities. What we're seeing now is we're involved in some capacity with 8 different banking deals, and only 3 of those have banks on the other side. So, in the past, most were bank-to-bank deals of some sort, but we have mortgage companies, private equity, fintech, credit unions, just groups of investors. So we have a lot of different people who are saying, and most of those groups are saying, we want the charter. And, I defer to Bob and Joe on some of those analytics, but they're looking at it differently. They may not have the AOCI concerns or hey, I need a 3-year earn back, and they want the charter, and they look at a de novo, and then they look at, can I buy an existing bank with some earnings and build on that chassis? So Brian, that's the shift we're seeing. The other thing I think we're seeing for the longest time, either if you were small, you'd sell for cash. If you were big enough, you might be able to attract a public buyer with some nice currency. We're starting to see people have advanced discussions with smaller to mid-sized banks where they might be willing to exchange private stock. Not necessarily an MOE, to Bob's point, and there's still going to be a lot of accounting issues, but the discussions that are taking place are, hey, forget multiples. Are we going to be stronger together if we put these 2 organizations together for whatever's coming than if we're apart waiting for things to turn, whatever that might be, whenever it may happen? We'll see if any of those get to the announcement stage or the closing stage. But to me, that illustrates my earlier point, which is pretty quickly people are saying, okay, I don't need 1.8 something. But if this makes sense, can we figure out if there's a way? Even if it isn't public stock and there isn't liquidity, we'll be bigger, we'll have more shareholders, we'll have a better balance sheet. And that's an interesting development we haven't seen in the past.
It's fascinating about what you're saying about the deals you're working on and how many non-banks are interested in acquisition. It tracks well to what we're seeing too, even on our side. So really interesting there, John. Bob, I'm going to circle back to the regulatory aspect of M&A. We've seen what I would consider to be contradictory signals from the regulatory agencies. On the one hand, some deals, including a very large one, didn't receive regulatory approval, and others that were announced quite a while ago still haven't received regulatory approval. On the other hand, the Treasury Secretary and the head of the OCC have talked about a more streamlined process for deal approvals going forward. And the Treasury Secretary in particular is seeming to almost welcome M&A as a way to force weaker companies into stronger hands. What do you make of the regulatory environment for M&A, just generally speaking? And how are you advising companies that would like to be acquisitive to be prepared for what may be ahead?
Yeah, Brian, we sense the tide is shifting there. M&A approvals got much more restrictive after Biden's executive order a few years ago. Certainly if there was a community group protest, in the deal, it got kicked to Washington, which turned into a black hole and really extended a lot of these. The larger deals, you kind of went in with the playbook knowing you're going to need to make a lot of these concessions up front in order to get the application approved. I do sense a pivot. It's probably too early to tell, given the lack of meaningful activity and sizable deals. I would say we're cautiously optimistic, but we've been advising clients to engage the regulators early in the process, certainly before you announce the transaction and before you file the regulatory app to, preview the transaction. They'll never tell you they're going to approve it, but they'll generally give you the stop signs if you can read the body language correctly. But we are sensing a shift in that coming out of this, there's going to be winners and losers on the structural profitability side, perhaps on the credit side as well. And it's much more efficient for the system to resolve itself organically. Where stronger players acquire weaker players, or simply two strong players just gain the scale they need to compete in this environment. So I do sense that they're going to be a lot more accommodative. Somewhat ironically, Joe's point earlier that we're not preparing for failures might put them on more of the longer approval track. They need people to take care of problem banks, and I think are ready to expedite those to the extent there's not a real rush or problem. Maybe that gets it goes back to what we've experienced for the last 2 years. We've also got a 2024 election, and depending on what happens with the administration and these heads. There'll be a period of nothing happening if things change over, and then a new, or perhaps a continuation of an old, tone in the regulatory approval. So we're optimistic, but we're not counting on it just yet. So we're preparing our clients to still be prepared for a longer approval process, but hopefully we can get back to 90 to 120 days, which was pretty standard for almost all the deals that we work on.
Brian, if I can just add to that, again, I agree with Bob, and I think going back to my earlier comment, if we start to see more and more of these deals where the buyers are not traditional banks and don't have a history of acquisition, that's going to lead to more of these pre-filing discussions, and you have to get the regulators at all levels acclimated. And if we're representing sellers, it's equally important, right? Before we are going to sign a definitive agreement and announce to the world, we want a high level of confidence that this is going to have a good chance of getting approved. So we're seeing a lot of that take place. But then on the flip side, again, as Bob mentioned, I don't remember the stat, so I won't cite it, but as with every other company, a lot of the regulators, especially in some of our regional offices, are approaching retirement. They have these cliffs coming where a lot of experience is about to leave. So, I think if not to put words in their mouth, but the fewer charters that they have to manage, the better, because they're going to have a headcount issue. So they're being very receptive and accommodating as we start to kind of color outside the lines and come up with some interesting structures and proposals. But to Bob's point, it's not the 45-day expedited, because it's not a one-rated buyer who's done 10 acquisitions. It's, hey, we've got something we want to talk about. What do you think of this? And then it's round after round of questions as you kind of go through that journey. And I think it'll continue that way for a while.
Yeah, I appreciate that, John and Bob. And I guess I kind of can glean that there's some new conversations happening around M&A. But I wanted to also kind of throw this back to both of you, Bob and John. Are a lot of these dialogues conversations that had been going and got stifled and now are resurrected, or are a lot of them really new conversations? Is there kind of a ratio that you're seeing?
John, you want to go?
Sure. Yeah, I think by and large, they are either new conversations or conversations that for the most part started last summer or fall, and then have continued uninterrupted but slowed down as people try to figure out, and I give most of the people engaged in these conversations a lot of credit, because it would have been easy to say, oh my gosh, let's just call it off and go away. Instead, they continue to try to work through, first of all, what do the rate increases mean? Then what did SVB mean? And so there's a few conversations that, are at or beyond the letter of intent stage, and keeping it together as they try to figure out, does this deal still make sense no matter what keeps being thrown at them?
Yeah, I mean, it's been a blend of both for us as well. Certainly conversations that were happening, pre-March, got put on hold. You're almost tone deaf, if that's where you're focusing on. Within the last 30 days, they've picked right back up. I would say meaningfully picked up, since March. But a blend of new discussions as well, new potential sellers, folks that are really maybe were on the sidelines as a buyer, and just positioning themselves to capitalize moving forward. Typically, and we saw this during COVID, when the deal discussions just put on hold and folks focus internally, you'll start to see the behind the scenes chatter. And then you'll start to see deal activity 3 to 6 months beyond that, after you kind of socialize the transaction, start to negotiate. I don't know if we'll see that, if it will take longer. I think the big question is credit and valuations. But folks are starting, I'd say, a meaningful pickup in the last 30 days, positioning themselves to do that. I don't have a high degree of confidence that means we're going to see a big pickup in 3 months. That could just be positioning to wait for 24. You'll have to see how the market accommodates them.
Bob, are you also seeing non-banks having interest in banks? Just to circle back to that point.
We have there's a bunch. In our experience there, I mean, the credit union bank M&A, that's a little bit of a different ballgame. But in terms of non-banks, whether it's fintechs, mortgage companies, investor groups, there's been a lot of interest. They have, particularly on the smaller side, they're a lot less sensitive on the price they're paying, so they can pay a small bank that's struggling much higher than a strategic other bank buyer may, because they want the charter and they're using it for the business plan. The number of conversations and deals versus the number that have closed, though, is different, because the regulatory approval process for a non-bank to acquire a bank isn't much different than a full de novo today. In fact, I don't think it's any different. So a lot of the time can be wasted if you have a buyer that does not understand what the regulators are looking for in this application. If they're forecasting 200-300% growth from this charter, it's not going to get approved. If they don't have experienced bank management and risk compliance and really all the back office functions really hired, ready to go, and is part of their plan, it hasn't been approved. So yes, there's a lot of them, but a lot of them I think too are going to have a hard time getting through unless the buyers really prepare themselves for what the banks are prepared to approve as they would a de novo application.
And Bob, on that point, or Brian, right? So one of the ones we had signed the earliest was last September. And as of now, it's on pace to close in September. And I do think it will close, but that, Bob, proves your point. That's a long arc. And I think one of the things we're trying to do from a gating standpoint, because on many of these we're on the sell side, is evaluate first out of the gate, who is the buyer's team? In other words, are they working with a qualified investment bank? Are they working with a qualified accounting firm and law firm? Is the law firm familiar with the regulators? To your point, because if you're going to have a business plan that talks about exponential growth, or we're going to go into 40 different states, you're probably dead on arrival. And so the ones that we're kind of allowing into the process and are making it to the letter of intent stage and so forth, there's a lot of vetting that has to take place before you even get to that point, because you're starting at a significant disadvantage. You can pay more and you will pay more, but what's the execution risk? So.
Yeah, thanks. And thanks for that thought. I know that, fintechs buying banks is something that we'll see if there's more of that coming up. I think you can count on one hand how many times it's happened successfully. But I want to get Joe back involved. But I do want to just ask one last question to Bob before I go to Joe. So can you just talk for a minute about the environment as you see it for capital issuance, debt, or equity? Would the market be supportive of some form of capital issuance to support an attractive acquisition? Or is the market still too unsettled and the outlook still too uncertain at this point to consider that option?
Yeah, no, we think there's a lot of dry powder, particularly on the equity side, to fund deals. In fact, most of them, and Joe can probably speak to this better than I can, but a lot of the long only buy side investors have sat out, the bounce up of 10-15% we've seen in bank stocks from the bottom, waiting to see how fundamentals shake out, waiting to see what happens with credit. But if there's an attractively structured acquisition, we absolutely believe there's capital to fund that. The question is, do they make sense for the buyer and the deal at today's valuation? So I think for the deal math to be attractive, we've got to see a little bit of more of a valuation bump before buyers and sellers will want to invite those. But a healthily structured M&A deal that needs additional capital to offset interest rate marks, I think if it's properly structured, we'd be able to raise that fairly quickly. The other side is, for folks that are maintain margin distress, whether or not if rates stay higher for longer, do they need to restructure their balance sheet and raise capital in more of a distressed form? And I think some of the investors have hesitated coming into those stocks at even really steep valuations, because that's certainly not an improbable outcome if rates stay where they're at for certain banks. The debt side, I think it's even though we've got rates that have gone up, I think is a little more challenging. It's more of a liquidity problem. Most of the sub debt that was raised by community banks was bought by other community banks and in some insurance companies and money manager funds, but they're overweight bank stocks right now in a looming potential banking/credit crisis. So I think that's a little bit tougher on the liquidity side. I think we need to see some of that flow through the system and clear off of these investors' balance sheets before we have a lot of room to get back to the kind of market we were on the debt side. That said, obviously, higher rates these deals can get done. It's just a matter of if they make sense in the context of a deal with valuations where they're at.
Brian, maybe just if I could chime in on this one. I think in addition to kind of, there's what Bob said about a well-structured transaction, but something that's unique to this cycle is if you go back to early March, it was really the failed attempt to raise capital that really ignited the situation at Silicon Valley Bank. And that really, really spooked people, right? And then throughout my conversations in May, I was surprised, and June, I'm still surprised to the extent that just about all banks I talked to were hesitant to announce anything that could possibly be misconstrued or taken the wrong way by the market or even by their community, regulators, whoever. So even something as simple as a balance sheet restructuring announcement. I was kind of, when I asked the question, banks, even if the balance sheet restructuring announcement made sense, they were hesitant to really put anything out there that could really, spook the market in any way. So I think that's kind of a little bit of an impediment that we have to get over, that is a little bit unique to this cycle just because of what happened with Silicon Valley.
Well, I want to stick with you, Joe. The next topic is implications for bank stocks. And so I wanted to ask you a few questions about that from all these issues we've been discussing. So first, do you think the outlook for bank stocks as a group aligns with the fundamental outlook you talked about earlier?
Brian, not necessarily. I think history is pretty clear that the stocks tend to bottom before the fundamentals do, right? And the challenge is, though, when you're going through the crisis period, it could be hard to know for sure what that defining event is that marks the turning point and you should be buying the stocks. Because after you get that defining event, history says you should be buying the stocks at that point. It might be bumpy for a while, but you might retest the lows, but ultimately you want to be buying the stocks at that point. So not to draw a direct comparison to 08, because I don't think the situation is anywhere near as serious maybe as what we went through in 2008. But there's an example from that period that I think illustrates the point. Bear Stearns basically collapsed in March 2008. Things seemed like they settled down for a few months, if you remember, after that, and then reignited suddenly with the collapse of Fannie and Freddie, and then ultimately Lehman Brothers in September of that year. Bear Stearns was a major investment banking firm, but you didn't want to be buying the stocks after Bear Stearns. So it was kind of a false signal that was the peak, right? Because as it turns out, Lehman was the defining moment. So the question I ask as an investor is, was Silicon Valley Bank Bear Stearns or Lehman? I think it's a very simple question. And my strong sense is that it was the Lehman event of the cycle. I'd assign maybe a probability of around 75 to 80% that this was the Lehman event, but it's still not an insignificant chance that it's Bear Stearns, right? So you could concoct a plausible scenario right now where interest rates go up by another few hundred basis points. You already have a couple of Fed voting members already that think we need another 100 basis points lift on the short end. You get further inversion of the yield curve. You start to layer on credit problems to that equation. If that scenario occurs, we're going to have bigger problems. But that's not my base case at this point. My base case is that Silicon Valley was the defining event. And while I don't think the stocks are going to come flying out of the gates anytime soon, like they did maybe in November 2020 after we got the vaccine announcement for COVID, my base case belief is that it's time to start getting more constructive on bank stocks, even as the fundamentals likely continue to deteriorate over the next couple of quarters, if that makes sense.
Yeah, and I mean, as a follow-up, within this general outlook that you've detailed, are there certain themes you think should be emphasized?
Yeah, so with the base case assumption maybe being that we're in the early stages of recovery here, but maybe with more of a U shape with the stocks to the bottoming process than the V shape, I think you could construct a portfolio where there's one component where maybe you're playing it a little more safe. As I said earlier, the largest banks, I think, and a handful of the large regionals in my mind are what I'll call the sleep at night names. We think we've got clarity on the viability of the business model. The earnings are reasonably projectable. The valuations are very attractive, especially in that regional bucket. I think the smaller names are just tougher in here. And again, there's still a little defensive component I think you want to have in terms of business model clarity and downside protection. But I think you can go around the country right now, and even though they're trading at a premium to the group at large, the best of breed community banks I still think are on sale right now. And then if you want to add a little risk, maybe to balance out the more defensive aspects of your portfolio, I think you can maybe look to the West Coast, where there are some very well-run banks that are, in my view, I call it, a victim of geographic proximity, right? To what happened with Silicon Valley Bank and First Republic. Again, there's more risk to this bucket. The deposit outflows for this group were higher during the panic, and some of these companies have significant commercial real estate exposure, including office. But I think these risks are more than priced into some of these stocks on the West Coast. Some of these names too, I think, check the box of being overly penalized and also best of breed, right? So that's the best of both worlds, and that you're getting a best of breed community bank, but you're not paying a premium for it. I think that sort of, if you think about the contours of that portfolio composition, that would allow you to capture the upside, right, in the base case scenario I outlined to you earlier, while also sort of reasonably protecting your downside risk in a still pretty uncertain environment. So that's the kind of some thoughts on how we think about playing it here.
And I appreciate that, Joe. I also wanted to make sure, Bob and John had so many great comments about M&A. I wanted to get your thoughts on M&A from an investor's perspective.
Yeah, I think it's very difficult, Brian, in this environment. You look at people involved in pending deals right now. There's uncertainty on getting your deal closed in this regulatory environment. The math gets worse seemingly every day. Today alone, we've got a 15 basis point move in the 10-year. A day ahead of the end of the quarter, right? So the fair value marks make the math get worse. Bob had mentioned that earlier. And for people announcing a new deal before we have clarity on the rate environment, as I said earlier, even if you can get there in terms of the rate marks today, you've still got the risk, especially for small banks. There's uncertainty on the earnings profile, what the earnings look like coming out of this. So you're taking this tangible book value dilution up front. And it could get worse, right? If rates move higher or the credit environment deteriorates till you close the deal. And you have to think the projected earnings accretion, the market's going to discount that even more heavily than it typically does because of the uncertainty about the future earnings. And then, I think when we inevitably do get an M&A wave, I agree strongly with what John and Bob said. I think it's going to be a good size M&A wave, and I think you're going to have more sellers than buyers. So think about everything we've been through these last 4 years now. Management teams are aging, boards are aging. There isn't viable succession in a lot of these companies. And so I think for the guy, I think John said it earlier, that was maybe holding out for 1.8 to 2 times book. Now maybe coming out of this, maybe a slight premium to book, and you get your change of control, gets that deal done. And it's a stock deal, and maybe the seller rides the upside potential in the acquirer. So I don't think you need to be in a rush to buy the potential takeout targets here as an investor. In fact, I think as an investor, playing the smart acquirers that have, the acumen, the capacity, the discipline, the currency to do deals, that's going to be the way to go, especially in the earlier stages of a pickup in M&A.
And before we move on to the next topic, I don't know if anyone if there's anything Joe mentioned that rattled a thought. And Bob, John, you want to chime in?
Look, I think the deal math is going to change, even if unless we get a dramatic cut in the rates. You're going to see even in a more certain environment. And I agree with everything Joe said. The impediments to getting deals done right now are the lack of confidence in earnings. Management teams are having an own time projecting their own margin and core earnings, let alone those of a target, and the unknown on the credit. Those are the big confidence pieces. But if those become more clear, and we're in an environment that has an elevated rate with these rate marks, you're just going to see more book value dilution and higher earnings accretion. It's going to change the kind of deal math that we saw moving forward. But there are also non-cash charges that they come back in if you hold the assets. It's a math equation. So these capitals rebuild quickly. They provide tailwinds. I agree, investors aren't going to put a terminal multiple on them because they are temporary. Once the assets mature, the market accretion goes away. However, you're then reinvesting at current rates. So it is a bridge, across an environment where maybe your core bank continues to see margin compression because of your own legacy fixed assets. We think M&A can help bridge that into a better piece. And the one part I agree wholeheartedly on is the best deals will be, the stock for stock, reasonable or reasonable premiums, where the seller and the buyer ride the recovery together. That'll give you, let's call it a year ahead on the integration and pulling out the cost savings of most of the other competitors if you're kind of early to the market. So we see a lot of value to that. And if you were to look back at deals that were done coming out of the financial crisis at low premiums to book, 110, 120, they rode those up to the 2 times wave that we had a few years ago. And on average went from, 115, 120 to 165, 180% of book 2 or 3 years later. The ones that did the deals at 180 to 2 times by taking 250 stock, wrote it down and are lower than the ones that actually announced the lower premium. that's generally hard for sellers to swallow because so much focus is on what the price is day one. It goes in the press release. It's the only price anybody remembers. But on a stock swap, particularly, you know, if you're going to hold over a long period of time, you really should be focused on the earnings accretion, the dividend pickup, and the balance sheet liquidity that you're getting as part of the bigger company, whether you're the seller or the buyer. And I think those are going to be the ones that prove out to be the strongest performers over the long term.
And there's a glass half full aspect to this too, right? Let's say that rates come down, inflation kind of comes down without sort of a massive credit implosion, right? And you get some deals announced. Now you have the deal math flipped to where it's been this huge impediment in the uprate environment. Now you've got a massive tailwind at your back, which could make, you know, reasonable deal pricing look even better. You know, to Bob's point about some of the deals that came out over 09-10, you know, those were done in a low rate environment. So the advantage this time would be if you announce deals and you can get the math to work in the uprate environment, then rates come down, it looks even better. So that's sort of the glass half full. I think we're a ways away from that, but you know, there is a glass half full aspect to this too.
Yeah, I mean, certainly the rates coming down is, you know, gives a lot of these ill-positioned balance sheet the magic do-over, right? Either organically or within the M&A context. And if you look at the forward yield curve, it's, you know, the market's predicting it's going to happen. Most of the bets have been on that it's going to happen, and so where we've kind of, you know, been looking at clients is like, sure, that's probably the base case at some point in time, but if it's not, you've got to be, you know, prepared to defend yourself if that doesn't happen.
Well, Bob, you said it, and we've talked about it before separately, right? The deal needs to be judged. If it's a stock deal, it should be judged 6 months post-closing, a year post-closing. You know, what you get to announce in the press release and tell everybody at the banking conference or the country club is nice. But I think we're seeing that too. People are saying, does this make sense later, even if I may take some hits on day one, which is different than what we've seen before. They're looking at the 6, 12, 18-month horizon and saying this makes sense. So even if, you know, the day one multiples might not be great, let's do it. And I think that's promising.
Well, I think as we talk about stock for stock deals, when we're advising clients on either side, it's either a win-win or a lose-lose. There's no win-lose, right? So, you know, on the price negotiation, you want a deal that works for both sides because you're both going to ride the market's reaction and the ultimate success of it moving forward. So it's either a deal that rises and works or it doesn't. There's not one where the buyer wins or the seller wins when you're doing an all-stock merger.
Well, thanks for those thoughts. I feel like we could probably continue on that discussion for a little while. I wanted to move to talent for obvious reasons. That's Travillian's bailiwick. But you know, you guys have peppered in succession planning and talent and, you know, executives into your dialogue here. Joe, I'm going to go to you, and Bob, you'll be the next question. You know, we've talked quite a bit about possible changes that we see in the operating environment and the evolution of this sector. So what do you think the implications are for the talent needs as we move forward?
Well, I think there's a huge need for talent. I think the small banks in particular are going to need a higher level of sophistication in the CFO and treasurer seats going forward. You know, for 15 years, we've had historically low rates. Before last year, not much volatility in rates. So the most trouble you could get into if you don't have the right person in the seat is that you're not really optimizing your balance sheet composition, right? But now the risk, if you don't have the right person in the seat, is you could blow up your company, right? And then I think, so the CFO and treasurer roles unquestionably, I think, are going to be focuses coming out of this. And then I think investor communications and messaging, right? There isn't great transparency in the bank balance sheets. And there's a lot of uncertainty out there. I think, look, at the end of the quarter, there are so many boxes for these companies to have to check, these small banks, from a regulatory perspective to a financial reporting perspective, that thoughtful investor messaging sort of gets lost a bit because it's not something you absolutely have to do, right? You have to do these other things. You don't have to be, have some, grandiose strategic messaging plan on your quarter and the outlook. But in an environment, I think, where investors aren't flocking to these stocks and they're illiquid, you have to be able to articulate your story. I don't think it's enough anymore to walk into an investor meeting like in the old days and say, I have an attractive franchise and I traded 85 a book, right? You should buy my stock. I don't think that's going to cut it in that environment. So it's those areas where I really see a pressing need, I think, coming out of this for a stepped up level of talent.
And Bob and John, I'm interested in your perspective on this as well as it relates to succession planning and M&A. You know, succession planning always seems to be kind of the root of the driver of consolidation over the last few decades. In your opinion, will succession planning play an even more significant role in this next wave of consolidation, and why do you think that is?
I'll give a quick thought and I'll kick it over to John. Look, it's one of the highest predictors of a bank selling is the CEO's age, right? And there's a lack of bench strength. There's a lack of new talent coming in. And gone are the days where the larger regionals and national banks had multidiscipline training programs. So, as a CEO of a community bank, you have to wear a lot of hats. The talent pool of that's multi-pronged that's been a longer term trend. And I don't see that really reversing. And I echo Joe's thoughts. The good news, I think, on the finance side is as you see consolidation, a lot of those positions get eliminated and it replenishes the talent pool. That can be repositioned at other banks as you need to to put some more quality or dollars behind those positions. But I don't see succession solving itself anytime soon. I think it's going to continue to drive M&A like it did prior.
Brian, I just have 3 quick comments. In addition to what they said, we're starting to see a little bit of succession driving it from the buy side. Right. In other words, if you have targets that you may not otherwise, you might look at it, run all the metrics and say, hey, this isn't exactly fit perfectly. But if they have some bench or some talent, that is being taken into account by certain buyers. Again, that won't be the sole factor, but if you can't find, hire, or lift out the talent, maybe you can acquire. The second thing we're seeing is technology. The bigger banks have plenty of technological staff and talent, but the smaller banks are starting to, realize they need it if they have any chance of surviving. Which is a unique challenge, as you would probably know, right? Getting the talent to come to a smaller financial institution has proven interesting. A lot of people are finally focusing on that. And then lastly, at the front line, a lot of our banks, especially the community banks in rural areas, are starting to realize they may not have any choice but to replace some of the front line with ITMs and other technologies. So we have a lot of people who have pretty big branch footprints and they just can't staff all of them. So they're relying more and more on ITMs and then just hiring a few people centrally to run all of them.
Interesting. Yeah. And the technology piece we'll get to in a little bit, but that's what we're definitely seeing. And I remember, I think it was TCF and chemical. I think tech was a big driver in that MOE that happened a few years ago in your footprint there. Stepping a bit further back in time, how have you seen, John, I'll ask you, how have you seen banks' talent strategies change post-COVID? Where will budgets be trimmed and or increased in your opinion? And then more recently here at Travillian, we've seen an uptick in lender and deposit generation, lift outs, if you will, in those types of discussions all over the country. Is this something that your clients are prioritizing in their talent strategy? Kind of tracks to what you were saying about succession.
I think it depends on the client, Brian, right? I think the ones that win and survive are prioritizing it. That doesn't mean everyone is. And not surprisingly to what you're seeing, if you're a revenue generator, deposit, and now on the deposit side in particular, those are the people who are most sought after. Secondarily, I think what Joe had talked about, people are realizing you're going to need more and more sophistication in your CFO, in your controller, your treasurer, no matter your size. And then lastly, the tech people. Again, a lot of our clients have not historically had a chief technology officer or anybody in-house. They outsource it all. And they're starting to realize that may not be sufficient going forward. In terms of other COVID trends that we've seen in other industries, including ours, I don't think our bank clients are seeing it as much in terms of remote work and some of that, competition. If you're going to have a commercial lender, that's not from 8 states away. Those tend to be boots on the ground. So I think they see it, but less than some other industries.
Ryan, maybe I'll throw on my old co-moderator hat here for a minute and throw the question at you, since this is what you guys do. Has anything changed from your perspective, I guess, in terms of talent needs and in these early innings after sort of what happened earlier this year? Are you noticing any sort of new trends? And is there anything you see from a talent perspective, maybe coming out of this that maybe we're not paying close enough attention to at this point?
Well, a lot of it's been mentioned, but I think, and thank you for bringing me in as a cameo panelist here. The succession planning, good succession planning is really, having your eye on your competitor and knowing who's there and just kind of keeping track of talent in your region, in your footprint. So definitely seeing a little bit more uptick in conversations around succession planning. But I mean, we've been intensely busy this year. We were a little scared in Q1, when COVID happened, things kind of petered off for a little while and it was almost a lost year. And we thought that, spending may have been derailed on talent, but it really has not been the case. It's just a candidates market right now. Good candidates are even harder to find. And a lot of our clients need to prepare themselves for some discomfort in terms of the cost of talent. This is an inflationary environment. It just is. And relocation is a little trickier now, if people are looking to hire outside of market. So just some things there that, banks need to kind of understand as they're jumping into a search. We've basically done like kind of a 60-40 split in terms of reload to hybrid. So there are banks that they got it right. COVID opened their minds. They're able to, to have some executives in other footprints, but for the most part, we're still seeing more traditional banks wanting people, at the HQ. It's no surprise, John, technology, we're doing a ton of searches around technology, payments, BaaS, and then a lot of those searches aren't just, production or strategic executive leadership, they're risk related around those subsets. So we're doing a lot of risk and compliance searches, which kind of tracks with this dialogue. And then I'll just opine on the CFO piece that everyone mentioned. I think it's actually our 6th CFO search this year that we're embarking on. Banks are looking for this next generation of talent to sustain that financial leadership. And almost all 6 of these banks are someone that's really, the banks are all looking for someone who is, looking forward to navigate, these unprecedented seas. I don't want to disparage any CFO out there, but a lot of CFOs were CPAs that could tell yesterday's story, today's story. We're really prioritizing people that have a little bit more capital markets, treasury, strategy, FP&A focus. And so that's really been, what we've seen in these CFO candidate pools. And the final thing is just about the lift outs. As I mentioned earlier, I talked to one CEO or a president of a bank in the Southwest this week, and he mentioned how his lift outs have been a great strategy. In essence, it's a less distracting, less risky, and more effective, cost-effective version of M&A. And they have the ability to cherry pick the best borrowers rather than, take the whole book at once. So as you saw with, I think, Dime in New York, lifted out a bunch of folks from Signature, and a few other banks have done that. I think you're going to see that happening more and more. We are almost at 3:00 right now, or actually we're past 3:00. So I wanted to just maybe ask one question for all three of you about Fintech. So Fintech stocks generally speaking up are a little, they're a little bit up on the year, which obviously stands in stark contrast to the banks. So asset quality at the Fintech lenders has, for the most part, held up well to date. And despite the implosion in the stocks beginning in 21 through the end of last year, and then some of the strict regulatory orders that have come down on the bank Fintech partnerships, I just want to know from your vantage point, where do things stand in terms of banks' relationships with Fintechs? And how are you advising your clients that are either in that business as tech-forward banks or contemplating a move into that business in the future? John, I'll start with you, and we'll go to Bob next. I know, John, we share a mutual client that does this.
We do, and you moderated a panel up in Minneapolis with them. So, one of our clients is Choice out of North Dakota and Minnesota, and they've partnered pretty successfully with a number of Fintechs. And I think that would be our answer, right? Too many banks can't figure it out or don't want to, or they think, they're competing with Fintech. And the right answer really is figure out how to assimilate it, figure out how to weave it into your strategic plan, whether it's, again, partnerships. There are a number of funds that have been created where banks are allowed to invest in these incubators and get first look at different technology that can, have two goals. it's a nice investment, and you can start to see different ways that you might want to integrate fintech into your business plan and strategic plan. So I think the real short answer, Brian, would be that the banks that are going to thrive and survive have to be paying attention to this, have to be strategic about it, have to be going to conferences and talking to folks and getting best practices. And you can't, if you think you can ignore it because it'll pass, you're going to be one of the banks we're selling very soon.
Yeah, I wholeheartedly agree. I mean, I think the partnership model as opposed to merging is the way it has to play out, not only from the valuation standpoint, but just cultural. You know, what makes these fintechs valuable is their ability to innovate on the fly. That's diametrically opposed to a risk management culture in a bank. I don't think they can really exist and thrive. So partnering to me needs to continue. And look, banks and fintech have been partnering since telephone banking, and probably before. This is a new term, but not really a new concept. As it relates to kind of the banking as a service model, obviously there's been a regulatory crackdown on AML and compliance surrounding that. I think it's not something you can dip your toe into. I think it's something you have to build a real function, which means you need to have scale. So I think you'll probably see less players there over time. I think the dollars probably increase. But there's folks that can do and manage that well, and there's folks that are kind of dipping in, and we're still going to see some consolidation amongst the fintech players, some significant consolidation. So I think it's something on the partnership side or the investing side, like John said, is going to continue to maintain. Acquisition, I just don't see it happening outside of the largest banks.
Yeah, and I know we may have lost some of our live viewers since we're past 3 o'clock, but this is going to live on in YouTube in infamy for decades to come. So I'm going to ask, unfortunately, the fintech piece we're going to move on from, but the final question I have, and I sensed a lot of optimism at times, and there's definitely some unknown, but I really just want to know, is your outlook glass half full or glass half empty? And why don't we start with Bob, and then we'll go to John and Joe.
Yeah, you put me on the spot because I feel it both. So I'll give you instead of answering full or empty. I mean, in the long term, as an investment banker that does capital raising and M&A, it's full. Like there's going to be a lot of that coming out of this. I think timing is really difficult. I'm sort of in the quiet for longer because I don't feel like unemployment's going to change and the Fed's going to either maintain or keep rates higher than maybe the yield curve suggests. So we'll see if that's right. I think regardless of where it ends up, folks need to spend time making sure they're in a position to do this. So I expect the next, 6 months, the remainder of this year to be quiet, people getting themselves in a position. But as Joe mentioned earlier, the best deals are going to be reasonably priced stock deals that happen early. And it feels like on the M&A side, people are getting ready, but no one wants to be, the first deal. But those first deals are going to be the ones that deliver the best returns for those shareholders before, massive, increase in competition and some of those benefits get arbed away. You get to do the deal with fairly low goodwill, moving forward, you get a year ahead integration. And so, I feel like longer term, it's certainly half full from where we're at today, but there's going to be pain. Banks cannot make money over the long term in this inverted yield curve. So something has to change for that to really be a precipice. And the last thing you want to do if you're well positioned in this environment from capital and credit is to acquire problems, whether that's over diluting your book or that's acquiring credit. So you have to be very careful at diligence, and the bid and ask spread between what buyers think of a seller's credit and what sellers think of their own credit is always an impediment when you're flipping from a bear to a bull cycle.
Brian, I would agree. I'm actually most days glass half full, depending on where I am that particular day. But I think for the industry, there's a lot of opportunity, and Joe and Bob have touched on it. There will be plenty of healthy, thriving, surviving banks going forward. And them when you're working with them. You can see the people who have the team, the foresight, they're strategic. One of the things when you were talking about talent, and earlier you talked about how things tend to trickle down, we're seeing smaller and smaller banks realize they need really competitive compensation packages, equity incentive components, if they're going to be able to attract talent and do these lift outs. So people that do that, people that figure out the fintech partnerships or relationships, I think there'll be plenty of opportunities to survive. And there will be a lot of banks that, for a number of reasons, do need to sell, right? And if they can't solve liquidity, succession, scale, those will be the opportunities for others in the industry. So I really think the one thing we always talk about with clients is, do you want to control your destiny or have it dictated to you? Because in the next 5 years, something's going to change. You don't have the choice of saying, no, I want it to be 1995 again. That's over. So how are you going to get from here to the other side of whatever's coming?
And Joe, you want to say
Yeah,
your last words?
I mentioned earlier, I think it's time to get more constructive on the bank sector. I think from these levels, you can compound capital and generate attractive returns. And I think you can control your downside risk. These stocks have underperformed for a long time. And I think the main reason for that is, we've had an unstable backdrop that these companies are operating within. We've had unprecedented monetary policy actions, and behind the scenes, that's created all kinds of distortions behind the scenes. With higher rates and QT, reducing the size of the Fed balance sheet, we're getting to a better place, I think, but the process to get there is painful. But ultimately, what you're going to have is a sector that won't be perceived to just be a play on interest rates and monetary policy. And I think, that's what it's been for the last 15 years. And I think the valuations, once we get to that point, will improve from levels today. The valuations are just about as attractive as anything I've seen in 25 years following the sector. But it's not a throw a dart type of environment, in that wherever the dart lands, you buy that stock and you're likely to make money. But I think if you put all that together, I know it's hard to kind of see from where we sit today. We don't have anywhere near, perfect clarity, but I think you've got the makings of the next bull market in bank stocks after this long period of underperformance. So I am glass half full.
Great. No, and I appreciate that optimism through a little uncertainty. Our viewers just chimed in. They want us to go another hour. So we're going to keep rolling here. No, I'm joking. Anyway, I thank you guys so much. I know we went a little past. Bob, John, Joe, thank you so much for joining us. It's really been a pleasure picking your brains, hearing your perspective. And I do hope everyone watching at home got something great from this dialogue. So again, everyone, I don't want to timestamp us, but have a happy holiday weekend. If you're watching this on YouTube, whatever holiday it is, enjoy that holiday next. But thanks so much for your time.
Thanks, Brian. I appreciate the chance to participate.